Hello, options traders, and I hope everybody had a wonderful Thanksgiving. And to wrap up this week, I wanted to create this video here to answer a post that I put up last week, mostly targeted at all of the new options traders out there, and to answer a very important question: are options risky? And there's no doubt in my mind that you've probably heard that from various sources and friends saying, whatever you do, avoid an option because of the risk. Well, to succeed with options and investing, you have to understand what an option is. And when you understand what they are, you're going to see that they're not really risky, although they can be used in risky ways, but they are in fact nothing but insured shares of stock. So let's take a little closer look at the question, are options risky? Whenever possible, I always like to start with an analogy to link the concepts together, something you're a little more familiar with. So let's take a look at the world of insurance. And let's say that you just bought this nice new flashy car here, and we're just going to put a price on it, let's say $50,000. Well, think about it at this point. If you shelled out cash for this, you really have two choices. Number one, you can go uninsured, and you can just drive the car as it is and take your chances. And if you do that, your maximum loss is the total value of the car. So in this example, $50K. But there is a second choice that you get, and that is to in fact insure it. And like most forms of insurance, we can get full coverage, we can accept a deductible, which means we're going to assume some risk, and of course, if we assume a deductible, it's going to become cheaper for the insurance. So let's just say, for the example, that we elect to have a $2,000 deductible, and in exchange, we'll get a little cheaper insurance policy. And we're going to assume we're going to be charged a $1,000 premium per year for this policy. I've highlighted this in red because this premium here, this insurance premium, plays the role of an option's extrinsic value, sometimes called the time value. And this portion of the option premium we never get back, just like it's true with the world of auto insurance. You never get this back. So if it turns out that we don't wreck our car, we lose the $1,000 premium. In fact, if we do wreck the car, we lose the $1,000 premium. That is the price or the premium that the insurance company receives for bearing the risk. So that is something we never get back. And in one hand, you could say that's what makes this a very risky proposition, because chances are we're not going to wreck the car and we're just going to lose the $1,000. However, why would we choose to do this possibly? Because if we do, we have a maximum loss of only $3,000. If we wreck the car and we're out $50,000, but we get $48,000 back, right? We've got a $2,000 deductible, but we also lose the $1,000 premium, so there's $3,000 that we have to sacrifice. Well, that means that we're only going to get $47,000 back out of our $50,000, and therefore the most we can lose is $3,000. So that's a benefit. So think about it at this point. Which choice is riskier? To go uninsured and potentially lose $50,000, or to go insured and potentially have a maximum loss of only $3,000, also keeping in mind that we will definitely lose the $1,000 premium. And when viewed in this light, I think most people would say that choice number one, having no insurance, is the riskier deal. So if this makes sense to you, it's exactly how it works in the stock market, and exactly the same role that options play. So let's take a look at long shares of stock. Now here's a profit and loss diagram, which I've talked about in previous videos. For anybody who's new, there is a separate video in here called profit and loss diagrams. But we just have stock prices across the horizontal here and the various profit or losses that could occur at expiration. So here we're looking at shares of stock purchased at 50. And so if we buy the shares at 50 and let's say the stock goes up to 60, I will make $10. If it falls to 40, I will lose $10. So the graph here, notice, is a straight line. And that just shows that we are going to make dollar for dollar as the stock price rises and lose dollar for dollar as it falls. So let's just assume this is 1,000 shares of stock purchased for $50 per share or $50,000. So very much like our car insurance example here. We are on the hook for potentially a loss of $50,000 because we've got wide open risk to the downside. Well, what could we do to insure against those losses? One thing we could do is to buy a put option. If I want full coverage, maybe I could buy the $50 put. And that will give me the right to sell these shares for that strike price of 50. So if I pay 50 for the stock and I am guaranteed to be able to turn around and sell those shares for 50, I take no loss at all on the shares of stock. However, it's going to cost me in this example $4 or $400 per contract. So if I have 1,000 shares, that's the same as 10 contracts. That would be $4,000 we'd have to shell out to, in fact, protect these shares from any loss whatsoever. And just like in the world of auto insurance, we will never get that $4,000 back. So why would we choose to do this? Well, look at what it does for our profit and loss diagram. We shift from this risky red curve to this much safer yellow curve. You see this bend right here at 50? That's our put option coming into play. If the stock drops to 50 or below, and notice it doesn't matter how far below that bend, we are limited to just the $4 risk. And that's why the yellow curve flattens out for all stock prices below that $50 strike. Well, that's a big benefit, but does it come for free? Not at all. Options are all about trade-offs. You see, if we stay on this red line, the uninsured stock line, our break-even price is $50. We begin making money for all stock prices above 50. But if we put ourselves on the yellow line by insuring those shares and paying this $4 premium, it increases my break-even. By purchasing that $50 put for $4, my break-even rises from 50 to 54. I've now shifted it forward by $4. And all things being equal, that would be a negative. We would prefer to see a lower break-even so that we start profiting sooner. So why might we choose to buy the put option and insure these shares? Because it eliminates most of this downside risk. So let's go back to our long 1,000 shares of stock here, purchased for $50 per share. Rather than saying I want full coverage and I don't want to sustain any losses at all below 50, let's say I'm willing to take a 5-point hit. I don't really want that insurance to kick in until 45. So in the world of auto insurance, this would be like taking a 5-point deductible. I'm willing to assume the first $5 of loss from the current price of 50 down to 45, and therefore I could potentially buy the $45 put. And because I'm assuming a deductible, just like it is in the world of auto insurance, we'll find that those put options will get cheaper. Rather than paying $4, maybe I pay only $2. What did that do for me? Well, it's changed my risk profile. Remember when we bought the $50 put, we were on this yellow curve. By buying the $45 put, I'm on this blue curve. And you can see the trade-offs here. By purchasing the $45 put, I am allowing for a little bigger loss, but on the good side, I have pushed my break-even closer to the current stock price. It's starting to behave more like shares of stock. What you're going to find is that no matter which put strike you buy, you are just going to cause little shifts in these risk graphs. So let's overlay all three of these together, our long stock and our $45 and $50 puts. And once again, you can see that there are changes. If I buy the stock by itself and do not insure, my break-even is 50. If I choose to have 100% coverage and buy that $50 put, my break-even gets pushed up to 54. If I'm willing to take a little bit of a downside hit and buy the $45 put, my break-even becomes 52. So you can see that that blue line up here sits in between the red and the yellow. So I can make my risk-reward graphs sit anywhere that I want. But in all cases, by purchasing the puts, I am eliminating the bulk of the downside risk, just like you will with an auto insurance policy. So once you understand how put options work, they are really an insurance policy on long shares of stock. Once you see that put options are an insurance policy against long shares of stock, I could go through exactly the same presentation, but just on the short side. And for people who short shares of stock, they could use call options as an insurance policy on short shares. So calls and puts, you're going to find out as you get more advanced, are really the same thing. It just depends on what we're trying to hedge. If we're trying to hedge long shares, put option is your insurance policy. If you're trying to hedge short shares, a call option is your insurance policy. But they work exactly the same way and for the same reasons. Now, interestingly, we can get some deeper insights into options by looking at a special trade called a conversion. And a conversion is the combination of long shares of stock plus a long put plus a short call. So for example, let's say that we have shares of stock at 50 plus a $50 put, but we've sold a $50 call. What does this do for us? Well, let's go back to our long shares of stock. And let's say the stock is currently trading right here at 50. If the stock price happens to be above 50 at any price at expiration, we will get assigned on the call and we'll receive the $50 strike price. However, if the stock price falls somewhere below 50, doesn't matter what the price is, even all the way down to zero, we could exercise our put and collect the $50 strike. And in the highly unlikely chance that the stock closes at exactly 50 at expiration, both options expire worthless, and again we would be holding shares of stock worth 50. So interestingly, I can use the calls and puts to guarantee that I can receive a certain amount at expiration. So if we put this conversion on with the stock at 50, this is what my profit and loss diagram looks like. It's a guaranteed receipt of $50 at some point in the future, whatever that expiration date happens to be. And because this is a flat line, it has zero risk. So it's kind of ironic that people view options as risky, and yet I can combine them in ways that I actually have zero risk in the account. So what you're starting to find out here is that options by themselves aren't necessarily risky, even though they can be used in risky ways. They are really designed as insurance policies. And depending on how we construct our trades, we can actually control the amount of risk that we're taking. Well, as we've just seen, the combination of long stock, long put, and a short call guarantees us the receipt in the future an amount equal to the strike price. In that previous example, we were guaranteed to receive 50 no matter where the stock price closes at expiration. Well, take a look at this. I can rearrange this algebraically. Let's get the call off by itself, and we find out that a long call is the same thing as a long stock position, a long put, and an amount equal to borrowing the strike. That's what that minus strike means. But take a look at this in the middle. The long call is a combination of long stock plus a long put. And that means that a call option is really an insured long shares of stock, plus a combination of borrowing an amount equal to the strike. So in a sense, you could go out and buy shares of stock, buy your insurance policy, but borrow an amount, let's say from a bank. Mathematically, it's the same as borrowing an amount equal to that strike price. And that is exactly equal to the call option. So if we look at that from a profit and loss diagram, up on top here is the long stock plus the put option or the insured shares of stock. The graph down below is the long call at 50. Notice they are absolutely identical. They are absolutely identical in every respect, even down to the Greeks, delta, gamma, theta, vega, rho. Both of these are 100% the same position. So when you hear that long call options are risky, you have to say that can't be right if they are exactly the same thing as insured shares of stock. Once you understand this formula for a conversion, we can use it in various ways to help us to determine better strategies for us. Let's rearrange this in a different way and take a look at the stock plus put on the left-hand side. That's our insured shares of stock. And that's the same thing as somebody who borrows money equal to the strike plus a call option. Let's take a look at some actual quotes and see if this is true. Here we're looking at the stock Square, symbol SQ, and I chose it because the stock was trading for $49.25, so just about $50, which was in line with our example. I'm going to enlarge these so we can see them a little bit better here. Let's say that we bought shares of stock for $49.25, and we wanted to insure them to make them safer. In fact, I don't want to take any type of a downside loss. I want full insurance, or insurance at 50, let's say. If I come down here and take a look at the puts, here's the 50 strike, and the mark is $3.15. So if I bought the stock and I bought the put, I would pay $52.40. Well, as I just showed, that should mathematically be the same thing as somebody who borrowed the strike price of 50, and therefore, how much else would they owe? If the stock plus put buyer pays $52.40, and the call buyer could borrow $50, he would have to kick in the difference of $2.40. So theoretically, that call option should be trading for $2.40. and we look straight over here, and it's trading for 235. It's a little bit off. There's a cost of carry component here, and there could be a slight skew, but you can see that it's very close to forming that guaranteed trade. It has to be. Well, what if we didn't want to pay the $3.15 here for this insurance policy, and in exchange we're willing to take a little bit of a deductible? So I buy the shares at 50, I'm willing to take a loss down to 45. That means I could buy the 45 put. We go over to our strikes, here's the 45 put, it's trading for about 98 cents. And that means as a stock buyer, I could pay $50.23 and have insured shares of stock down to 45. Well, I can mathematically mimic that by going out and borrowing $45 and paying the difference. So if it cost me $50.23 to buy the insured shares, and I'm going to borrow $45, how much would I owe? I would owe $5.23 difference. And we look straight over here at the value of the call, and it's trading for just about $5.23. So to fully understand options, you have to realize that call options are nothing more than insured shares of stock combined with borrowing. But once again, you're not actually borrowing. It's more of a mathematical type of borrowing. So the leverage does come from borrowing, but because we're insured, we always have limited losses. And that's what gives us the power of options. So to succeed with options, it all comes down to understanding. Understanding what an option is and what it isn't. And that's your first step in understanding the art and science of options trading. If you are comfortable trading shares of stock, you should not in any way be fearful of trading call options because they are nothing more than insured shares of stock. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com.